Welcome to Classic Value Investors. My name is Mariusz Konieczny. Today I have with me online Keith Weiner. Keith, thank you very much for agreeing to do the interview with me.
Thanks for having me, Marius.
Keith, I listened to some of your interviews. I was very impressed with the knowledge that you have. But for my audience, can you just kind of introduce yourself? Tell us how you became interested in money and just your background.
Sure. So, as a kid, I was your classic computer nerd. Went away to computer science school. Dropped out of that because I had the dream that so many of my heroes before me, dropped out of school to build a software company, which I did. I founded Diamondware in 1994, sold it to Nortel Networks. We were the last acquisition Nortel ever closed, by the way, August 19th, 2008. So
Right before the crash.
right before the crash. We were the last acquisition they did, probably one of the last acquisitions anybody did, because around September, the wheels really began to start falling off. So as I'm sitting there post transaction um, with all of my wealth and cash and a couple of too big to fail banks, and watching what was unfolding, I started to study markets and economics to try to figure out how to protect myself. I found that everything they said in the mainstream media, and even what I would call the more sophisticated, barons and investors business, what's it called? Uh, Investors Business Daily, I think, Wall Street Journal, just didn't really explain the root of anything. It just seemed like it was starting in the middle and, sort of chasing its tail from there. So eventually started to study monetary economics under a Hungarian professor who spent his career teaching mathematics in the Canadian university system, and retired from that to focus on his love, which was monetary economics, earning a PhD from his new Austrian School of Economics, which is not accredited, so nobody should offer me a job based on that credential. But the motivation began with just how do I protect myself, evolving into there's a very, very grave problem in our world, and if it isn't corrected, civilization is going to collapse. So I began to really think about how can that be averted. And I recall this quote. A lot of gold people will know at least part of it, where John Maynard Keynes is talking. He's posturing and pretending to quote Lenin, but he clearly agrees with it about there's no surer way to overturn society than to debase the money, blah 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 blah. You arbitrarily enrich some, and everyone else is impoverished, and even the bourgeois will hate each other. It's a pretty long quote, but at the end he says, by engaging all of the hidden forces of economics in favor of destruction, and not one in a million can diagnose what is happening. And of course, today, our term for hidden forces of economics would be incentives. So he's saying by engaging incentives that nobody really understands, um, we can destroy the world. And I completely believe, and I've written a lot about this, that he intended that destruction. That was purposeful on his part. That he was a real bastard. But I kept thinking about what if somebody were to offer an incentive not for destruction but for salvation, and that was the kernel of the idea that became monetary metals. So if the world were normal, I would have done another software company. I had a great team that had followed me to hell and back, through the Diamondwood journey. I had access to capital, had great advisors, tons of ideas for what we could do in that space. Um, and we would have done it. But because the world is in the position that it's in, I said, I want my next venture to be part of the solution. And that is, we have to find a way to offer the right incentives to move forward to the gold standard. And so that, in a nutshell, is my background as pertains to this.
Oh, okay. Thank you for that introduction. Now, one thing that really caught my attention from your speakings is that if we're talking about inflation in the Austrian School of Business, Austrian School of Economics, you hear a lot of people talk about how inflation, the definition of inflation is inflating the money supply. So then they take that and then they say, well, if the money supply grows, that automatically means the prices will increase. But according to you, that's not necessarily the case.
Right, and I think the period 1981 through present is the proof. Um, I've written a few years ago now that I bought a pair of Levi's 401 blue jeans. I think this was 2016. I don't remember, 2017. I don't remember when I wrote the article. I paid $35 for these jeans. And what was interesting to me was I recall when I was in high school in 1983 buying a pair of Levi's 501 blue jeans for $50. And so if this theory were to be true, I mean, you can argue China, you can argue computer aided manufacturing, more efficient supply chains, you can argue all that stuff all you want. But if that theory were true, there's been such a staggering, stupefying, enormous increase in the quantity of what we now call money, but which isn't money, which is a whole different topic, which is the US dollar. There's been such an increase of it beyond any proportionality or any probably even expectations of the worst doom and gloomers in the 1970s as to how bad it would get in terms of increasing the quantity of the dollar. And yet the price of jeans fell 30%. Not a small drop, and certainly not the skyrocketing rise that the theory should predict. So that should be one of the clues. And then of course post 2008, the increases in quantity dwarfed everything that occurred between 1981 and 2007. And we've had not just one drop in the price of oil, but two drops, and both of them were epic collapses. Right? We had a collapse from 110 roughly to what it was a low of around just under 30, I think, in 2014 to 2015. And then, a couple of months ago, again, we had a giant drop from, in the 60s to, there was one day that if you had a tanker truck ready to accept delivery of a contract in Cushing, Oklahoma, they paid you $38 to take the oil off their hands. That is, the buyer was paid, or you could call it a negative price of negative $38 a barrel. And so clearly there's something wrong with this theory. That's just the evidence that's available to, I kind of think of it as what if you had a smart eighth grader? What would a smart eighth grader be able to see? And when you drill down into it, you realize all the assumptions that underlie the theory just don't quite make sense. They're like sort of approximate, almost, and good enough. So we call it a money supply, and they try to compare it to the goods supply. So if the money supply is growing faster than the goods supply, then you get rising prices. But the money supply is not a supply in the sense of something that is being produced and then consumed at the same rate as it's being produced. So oil, whatever barrels of oil is produced, is consumed almost immediately. So you could call that a flows and call it X number of barrels per year or X number of tons per year. But the so-called money supply is really a tons or a dollars, but not a per year, because of course money is not consumed in a transaction. And so if you take science and engineering classes, one of the first concepts you have to learn is to look at the dimensions of both terms on either side of the equation. And it's kind of like comparing how far my house is from my office to how fast the plane is going from, New York to London. They're not comparable because one is a miles per hour and one is miles. And so the theory breaks down, even at the assumptions that nobody really talks about and nobody really names. And so I've developed my own theory, and people can Google Keith Weiner theory of interest and prices. One other observation I'll share, very early monetarist Knut Wicksell in the 1890s expected to find, and he did some meticulous research and put together the data, he expected to find that the price level correlated to the quantity of money. But what he found was that's not so. It correlated to the interest rate. Although he couldn't explain it, he was honest enough to say, this is what it actually correlates to. And then later, Gibson studied this, and we now call it Gibson's paradox. And it's no paradox if you look at it properly. Think of prices and interest rates as being correlated rather than prices and quantity.
Very interesting. And now that we're talking about interest rates, uh, in one of your interviews, you said that debt has to grow exponentially so that the interest rates have to come down. Can you explain this a bit?
Yeah, okay, so let's break that into the two halves of that statement. Um, when President Nixon in 1971, in a day that should live in infamy, August 15th, 1971, declared that the US government was going to default on its gold obligations. So, rewinding back to before 1913, before the creation of the Fed, and even up until uh, the election of President Roosevelt in 1933, um, the dollar was redeemable in gold. That meant that you could bring a $20 bill to a bank and pass the piece of paper, the credit note, over the counter, and then they would give you a coin of just a bit under 1 ounce. And so people say the price of gold was $20 an ounce. That's not quite right. It wasn't a price. It was a redemption value that when you deposited your gold in 1 ounce increments, they gave you $20 increments of bills, and you had the right to get your gold back. It was a deposit agreement, not a purchase. So 1933, Roosevelt says the dollar is no longer redeemable to U.S. citizens. In fact, it's illegal to even own gold. He was trying to get control of the monetary system. So today, all of those reasons that Roosevelt had in 1933 are just not applicable. But anyways, the dollar was still redeemable to foreign central banks and foreign governments, which as you think about heading into the 1930s, the U.S. government wasn't really worried that they would be redeeming because the governments of Europe were interested in bringing more gold to the U.S. where it was safe from the war that they started to all see was coming. And so in the post-war reality that emerged, of course, those countries are very poor. I'm sure they had to pay a lot of that gold to the U.S. for aid and munitions and whatever else, and reparations. And so there wasn't any withdrawal pressures at first, but into the 1960s, the pressures to withdraw the gold, began to rise. By 1971, it was hundreds of tons a day, I think, was the redemption rate. So 1971, Nixon says, okay, you can no longer redeem the dollar for gold, even if you're a foreign central bank. And unwittingly, and by the way, this was on the advice of Milton Friedman, who everybody thinks is a free marketer, and he was not a free marketer when it came to money. Um, so now we have a regime of irredeemable paper currency, which we all pretend is money. Well, one of the functions of money is to extinguish a debt. And when you eliminate gold from the monetary system and you say everything has to be paid in irredeemable dollars, the dollar is itself a debt instrument. So we pay debts using a debt instrument. And so it becomes a game of moving the lump under the rug. The debt can never be extinguished. It can only be shifted around from one balance sheet to another. Suppose you and I go to a restaurant and we owe the restaurant $100. So I take out $100 bill. Bill, by the way, being an arcane word for a credit note. The $100 bill does not say on it bill. It says Federal Reserve note. Note is another word for credit. So we give the $100 credit note to the restaurant, and now we're out of the debt loop. But the debt doesn't go away; it merely shifts. Now the Federal Reserve owes the restaurant $100. Now, the next day, what is the restaurant going to do? Well, they're going to deposit that $100 bill in the bank, and now the bank owes the restaurant $100, and the Federal Reserve owes the bank. What is the bank going to do? Well, the bank's going to buy a treasury bond, or maybe some other kind of bond, but often treasury bonds. So then the treasury owes the bank, who owes the restaurant. So all we do is shift it around, but most of this debt is owing interest to somebody somewhere. And since the debt itself cannot be paid off, that means that the interest that accrues cannot be paid off either. And so the debt must increase at an absolute minimum by the accrued interest over the course of the year. And it turns out it has to increase much faster than that because you really have to make sure that the marginal debtor can get enough dollars to service his debt. And so there must be um, an exponential rise in the quantity of these things circulating around just in order for all the debtors to keep servicing their debt. Now, that leads to another problem, which is if you're struggling to service $1,000 of debt, what happens when your debt gets to 10,000 and 20,000 and 50,000 and 100,000? And so the only way to make that manageable and serviceable is for the interest rate to drop. Since no one is, in aggregate, we're not effectively paying off the principal, we're only servicing it by paying the interest. So if you lower the interest rate, then that makes it possible for everybody to service it. So every time someone has been saying over the last decade or so that I've been in this, the U.S. government is going to default because the interest rate is going to rise, and then they won't be able to pay the interest anymore. I say, oh no, no worries. The interest rate will keep falling to accommodate them. And everyone said, Keith, you're crazy. Well, I've been so consistent and so loud, bellowing from the rooftops about falling interest rates that a lot of people are aware that I've been making that call, and I've been pretty alone in making that call. Well, late winter, early spring, we've seen the interest rate fall so much that the 10-year Treasury fell to 0.5%, and it's not going to be returned, of course. And so, here we are in this, nearly zero interest rate regime, even on a bond as long as 10 years in duration.
So, yeah, okay. When I was a little kid, I remember our parents or grandparents were getting 15, 16% on their money that they had on their CDs. And of course,
Mm-hmm.
now no one can make any money having money in the bank, which is consistent with what you're saying. But so do you mean that we are in this low rate environment like forever, permanently?
Well, at some point, the entire system collapses, which is a whole different discussion. But when someone says to me, Keith, no, interest rates are going to begin to rise right now because whatever factor, I was, the debt is rising or the risk is rising, whatever. I would say two things to them. First of all, how many times has that factor been present over the last 40 years? That's not a new factor, and therefore you shouldn't necessarily expect, a mega trend like that to turn around. But secondly, before you predict a turnaround of a mega trend, you should owe it to yourself to understand what drove it to happen in the first place. Why did interest rates fall for 40 years that you suddenly think that the driver of that is over and done with? And so my argument is the driver is not over and done with. The driver of so let me give a really brief encapsulation of my theory of interest and prices, and that is it's a dynamic system and with positive feedback loops. And so when the central bank pushes down the interest rate, and make no mistake, the purpose of having a central bank is to enable the government to borrow more than it otherwise could at lower rates. So the central bank is created in 1913 in the U.S. to push down rates, which it did. But unfortunately, what happens is the interest rate is pushed below marginal time preference. And governments always think that they can change natural law or economic law, and the best that they can do is force people to pretend as if economic law had changed. But of course, reality is not so. So when the interest rate falls below time preference, um, you get this perversity of people responding to that by hoarding commodities. And so they start to drive up prices because there's a net increase in commodities demand. And when businesses begin to realize that this is happening, businesses begin to borrow to increase their buffers. They don't think of it as commodity hoarding. They think of it as increasing inventory buffers in between each stage of their work in progress on their manufacturing process. So now you have borrowing, which means selling more and more bonds at an accelerating rate to buy more and more commodities at an accelerating rate. So you have bond prices falling, which is the same thing as saying interest rates rising, and you have um, commodity prices rising. So you have rising interest, rising commodities, which is the brief little trend that was limited because you still had effectively a working gold standard in the United States from 1913 to 1933. What happens, and the cycle turned in the 1920s, is when interest rate gets above time preference, um, it can also get above the productivity of the entrepreneur. And so when that spread reverses, now you have interest higher than the productivity of the entrepreneur or the return on capital. The entrepreneur can no longer borrow. So things become a bit like a depression, and everybody wants to sell capital assets in order to pay down debts. So that trend lasts through World War II, through 1946 approximately. And then in 1947, we get another rising cycle, which takes us to 1981. And then we have a falling cycle ever since. And the falling cycle is when interest is above the marginal return on capital. That's where we are today. They've made interest so cheap that everybody can borrow, whether you want to build another hamburger stand, whether you want to buy more printing equipment, open a print shop, whatever it is that you want to produce. The cost of credit has been held not only too low, but too unresponsive to changes in supply and demand. Right? Normally, in a free market, if there's too much hamburger capacity, then anybody in the hamburger business finds their cost of capital going up. But in a centrally planned, centrally banked world, the cost of capital goes down regardless of supply and demand in the hamburger market and all the other markets. So we're now in a place where you as the saver can't get any return on your capital because the businesses who borrow it can't get any return on the borrowed capital. So it pushes all returns on everything extant down and down and down. That condition still applies today, even more so. Who's going to borrow money today for what purpose?
Wow.
And what return are they going to get?
Wow.
So it's a very bleak situation. But if you want to fix the problem, you have to understand the nature and the cause of the problem.
Wow. Very, very interesting. I need to myself look into this because this kind of thinking is very new to me. Okay. Right now, especially with this COVID situation and what the Fed is doing to um, quote unquote help um, the situation, we hear a lot of people talking how the Fed is printing money. Now, in your opinion, is the Fed purchasing financial assets really printing money?
They're borrowing. I mean, the Fed, in some ways, is not like a bank because it has the power of the government behind it, but in a lot of ways, it's like a bank. What does a bank do? It borrows at a lower cost of interest to finance the purchase of something that earns a higher rate of interest. And that act of borrowing should not be considered to be printing. It's not, when the Fed, if you have $1 million of bonds and the Fed buys the bonds from you, that's not a gift of $3 million in capital. That's an exchange of $1 million worth of bond for $1 million worth of Federal Reserve notes. Um, no party is getting free value created out of nothing.
Okay. So how does how does gold fit into your theory? Because obviously you like gold.
Right. So in my theory, gold is money, and money is the thing you want to own when there is not an investment that is more attractive. So I always cringe when gold people say gold is going to outperform, the stock market, because in a sense what they're saying is, the real return of productive enterprise is negative. God help us all if that's really true, because that means that civilization is retrogressing back to a dark age, if that's true. But at the moment, amidst all this monetary planning, amidst record high levels of debt, amidst the only solution that anybody can think of, whether fiscal or monetary, is to lend and borrow more and increase the debt, um, people increasingly think of owning money because owning money, you don't get a positive return, but you don't have a negative return either. And so there are two things that have changed. Um, let's call it over the last 6 months. And obviously, COVID is roughly half of that, right? So one is there used to be a return on the 10-year Treasury. In fall of 2018, you could get over 3% on the 10-year Treasury. And whatever else you might think of the U.S. government, over a 3% return, a lot of people thought that was pretty sweet. Um, and I said to everybody at the time, that's a bargain because not only are they paying you that interest rate, but you're going to have a certainty of capital gains to come. When the interest rate falls, that means that the price of that bond rises. You'll have a nice capital gain, and you're paid 3%, over 3% in the meantime. As recently as January, the interest rate on that same 10-year Treasury was, if I recall, 1.8%. I'm not looking at a screen at the moment. Um, so you still had some sort of interest rate. Now, starting in late February, starting in February and into March, the interest rate collapsed to 0.5%. So the first factor that's happened to any saver and any investor is that your return has been taken away. I mean, whatever the attractiveness might have been at 3.2% in 2018 or 1.8% as recently as January, they've all but sucked it dry. At 0.5%, 0.6%, there's no there anymore. You're not getting much of a return, if anything, anymore. And at the same time that that's happened, the federal government has gone. There's a great website called Debt to the Penny, which is published by the U.S. Treasury. And so you can look at any period of time and see what the debt was, in between any two dates. And so if you look at the 12 months that ended March 31, which was right before the COVID response, right? They passed the so-called CARES Act. I think it was at the 28th or 29th or something like that. So, within 2 days, I don't think they had spent much money, if any, on COVID yet. That 12-month period, the federal debt increased by $1.7 trillion. Now they claim a deficit of lower than that. There's some accounting gimmick. I haven't quite figured out what the gimmick is, but 1.7 trillion is the baseline deficit. To that, they added 2.3 trillion for the so-called CARES Act, then another half a trillion for the supplement to the CARES Act because they didn't give away all the money to all the people that they wanted to give it away in the first one. And so that brings us 1.7 plus 2.3 is 4, and then plus another half a trillion is 4.5 trillion is what the deficit is running on an annual run rate post the CARES Act. And I think that tax revenues will probably drop $1 trillion this year. That's just a wild guess, but I think probably in the right ballpark. So you're looking at 1.7 plus 2.3 is 4, 4.5, $5.5 trillion deficit. And that's assuming they don't do any more stimulus, any more bailouts, which I'm sure they will. So at the same time that investors have been deprived of any decent return on their investment, the risk has gone up dramatically. It's not a government running 1 point something trillion deficits anymore. Now it's a government that's going to be running a 6 trillion or more deficit. So anybody looking at that rationally, and they don't have to be gold people. And in fact, if you're looking at the gold price, these have to be people that didn't used to be gold people, looking at this and saying, "This is insane. Why would I want to be a lender under these circumstances?" And I think just like in 2008 to 2009, there was a whole new crop of people that came to gold for the first time who'd never owned any gold prior to that. There's now surely a whole new crop of people that are coming to gold that didn't own it even in the wake of 2008. That in the wake of 2008, they looked at the government's response and said, "Yep, yep, that makes sense. That's okay. The government's doing all the right things to fix it." That are now looking at it and saying, either this is insane, or at the very least, they're saying, "I'm not being paid enough to compensate me for the risks that I'm taking to be, financing this." And so then they turn to gold as kind of the anti-investment.
Okay,
You
so
have a
what you
lump of
okay, so what you're saying is that the deficits in the current situation will create a brand new demand for gold that wasn't there over the last 8 years or so.
Yeah, I would think so. And well, the deficit's being half of it, and then depriving investors of any return. So now it becomes a return-free risk. And I didn't coin that. There was a hedge fund guy that coined that term. I don't remember who. It's a return-free risk, and so a lot of investors are going to say, "Well, I don't like that." Then they can turn to properties, but I think there are a lot of very negative dynamics of real estate right now that can turn to equities. But I think there's huge negative dynamics for equities. What are you going to own that's going to be safe in this environment? And then gold comes up on the short list because you've ruled out everything else.
Right, right. If you asked, I don't know, 6 months ago, um, gold bugs or people interested in gold, that if you told them that this is what the Fed's balance sheet is going to be like, this is what they're going to be doing, um, they would probably say, well, if that will be the case, gold will blow through 2000 in a hurry. And here we are sitting at just a little bit over 1700, and a lot of people are asking, why isn't gold higher right now at this point? What do you think?
So it comes down to the theory of why does the dollar have any value at all? And I think most gold people would say, well, it's just faith. It's just a belief system, and one day it's going to go poof, and then of course the gold price will go to insert your favorite number, $50,000, $100,000, whatever. And I always say, no, it's not faith. It's the struggles of the debtors. If you are a farmer and you borrowed $1 million to finance the land and the tractors and everything else, one thing that you're absolutely certain to do is to plant and harvest as much wheat as you possibly can in order to sell it to raise the cash to service your debts. So the more people that are in more debt, the more that they're working frantically, frenetically hard in order to produce whatever it is that they have, which they dump on the bid, by the way. So the more people that are frantically producing the more wheat, the more they tend to push the price of that commodity down, which is again tying back to why falling interest rates leads to falling prices. In order to desperately raise the cash. Because if you don't service the debt, then they foreclose and they take your tractors and they take your farm and they take your house. So everyone is working to do that, and so they're working really really hard. And so one of the reasons why people might buy gold as a hedge against inflation, and that factor isn't really here today, other than in certain very limited food areas where the government has destroyed the supply chain, like the meatpacking plants that were all been closed due to COVID fears. The prices of everything else are falling. So for anybody who says, "Well, I'm going to buy gold to protect me from skyrocketing inflation," they don't see skyrocketing inflation. So therefore, that reason for buying gold isn't really on the table. The other factor that people need to think about is that when somebody's business is ruined or somebody loses their job, they have to start selling assets in order to buy food. And I'm sure there's some selling of gold, um, and definitely selling of silver, mind you, um, to enable people to continue to live their lifestyles. So in the market at any given time, there's always a tug of war between, people say bears and bulls. I don't think the people who are selling their gold in order to put food on the table are necessarily bears. They're forced sellers. um, Even if they love gold and even if they think gold's going to go to 50,000, they're not in a position to hold it because the government's response to the virus has financially destituted them, and so they're selling not out of any conviction about gold, but out of a need to eat.
Yes, yes. When you, Keith, when you go and speak at various conferences, because of your unique view, do you get into like disagreements with the Peter Schiffs or Jim Rickers of the world that probably don't see it the same way?
Well, obviously, if you read my writings and you read their writings, or you see videos of my talks and you see videos of their talks, we disagree, of course. I try not.
You disagree, even though at the end of the day, you you see gold as bullish, but how you arrive to it is different. But I was just
Right.
wondering if you get into these disagreements with each other.
I try not to, make any personal attacks. I try not to make it personal. So yes, I mean, I disagree with both of them on a lot of things. I disagree. I do agree with them on some things as well. Um, and that's disagreement is what makes the world go around. Now, all of that said, obviously, if you read, even a small fraction of what I've written, you see that I have a unique viewpoint that isn't really shared by anybody. And so I'm obviously aware of that, and conference organizers are aware of that too, and so they may either exclude me or include me based on whether that view is going to advance the interest of the conference or make money or whatever. But I'm always aware of the need, since I'm of the Austrian School of Economics, but I have some key differences. So I'm always aware of the need to build that body of work, that edifice that supports the school and the theory. And so rather than fighting with anybody and taking off the gloves and going fisticuffs out in the parking lot, I'd rather go write another essay and try to explain one more key point. And the more that I build up my, it's not my body of work in a personal sense, but the more that I develop my theories and my ideas and integrate them into kind of a larger whole, the more that people can see that there's something to what I'm saying. And so, of course, if there is a debate, um, I want that debate to focus on, well, was I right? Was I correct in what I said? And if I'm wrong on a matter of fact or a matter of logic, then tell me where you think I went wrong. But if you can't do that and you just rather say, you rather dismiss me, well, I don't um, I don't pay any heed to that.
Yeah, yeah. Okay, Keith. One final question that I have for you kind of ties together with you selling the software company and not starting another one. When I was a kid, I lived in Poland, and I didn't come to the United States until 1996. But I remember going through a period where in Poland we had hyperinflation. So I went from seeing my mom, I don't know, making thousands of dollars per month, and in Poland everything was how much you make per month, not necessarily how much you make per year. So she was making thousands of dollars per month, and then months later or a couple years later, she was making like 30 million per month. So obviously huge hyperinflation. And she had some money saved up. I don't know if it was for house down payment or whatever. But by the time the hyperinflation was done, that down payment was only good enough to buy like a dishwasher. Uh, but in other words, if you had your money in cash, you lost a lot of purchasing power. However, if you had your money, if you had a house, if you had gold, if you had a good business, you were okay because your house adjusted to different money. After they changed the money, it was just worth something else in different money. Gold also adjusted in price, but also a business that was um, useful to society also adjusted. It started accepting different money, and it was fine. So your software business was obviously useful to society, and that's why you sold it. But you could have easily started another software company, and as long as it would be useful to society, why wouldn't this starting another software company be just as good as what you chose to do?
Okay, interesting point. So I agree that every business that makes money, at least in a free or semi-free market, so we won't talk about cronies that profiteer on government subsidies, but every business that does something that people value and want to pay for is making society wealthier and improving everybody's lives. And that would be true whether I started a software company or a gold company. But um, the world's monetary system is leading us down the path of destruction. and building another software company would not have done anything to address that. And the gold company, Monetary Metals, that I have founded and that I'm building is doing something to address that. And if I may, I just want to talk about our value proposition, not really to try to sell it, but to talk about what the mechanic is and why I'm doing what I'm doing. Um, if you say to people, we should have a gold standard, the first objection that you get from the average paper bug is there isn't enough gold. And I always like to play with those people a little bit. And I say, well, how much gold do you think we would have to have? And, you know, and how did you arrive at that answer anyway? I mean, is it like, the Hitchhiker's Guide to the Galaxy? The right answer is 42. Um, but on a more serious note, I think the average gold person would respond and say, it's just a matter of price.
Right,
And
right.
I take exception to that and say, well, people would have said that in the late 1990s when the price of gold was $300. And when it went to $2,000 or just under in 2011, gold was no closer to circulating than it was at 300. And the same thing would be true at 20,000 or 50,000 or whatever. A rising price of gold will not usher in a gold standard. So, what does it take for gold to circulate as money? And so I've written a great deal of material on this. The interest rate is the regulator of flow. If the interest rate is zero, there is no flow. And even if you had a working gold standard where gold coins were in circulation, as the interest rate went to zero, one by one, all of those gold coins would be picked out of circulation and hoarded because people need to save for retirement. And if they can't invest and lend their gold in order to get a return, then the next best thing is to keep their gold, at home. And so then the gold would be pulled out of circulation and a working gold standard would actually stop even if we had one, let alone you'll never get one started. So the key is paying interest. And then getting back to John Maynard Keynes and that quote about perverse incentives or engaging the hidden forces of economics in favor of destruction, this is how he put it. I think, okay, well, what's the incentive that would lead people to move to the gold standard? And the answer is if you can get interest on your gold. If you can deposit 100 ounces of gold and get 3% interest, that means you have 103 ounces at the end of the year. That is interest as the force. In fact, it's the only one that will pull gold out of private hoards and back into circulation. So the vision of monetary metals is to pay interest to everybody who wants it. And that, of course, is a good working definition of the gold standard. The gold standard is when anybody who wants to can deposit their gold and earn interest on it. Now, they have the right, but not the obligation. It's important that it not be some government that takes everybody's gold and says, oh, trust us. We promise. You see that quantity of dollars you have over there? We promise to have a hoard of gold over here to back it. No, 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 no. It's everybody making their individual decision every day of the week. Do I prefer to hold the gold coin or do I prefer to have a bank credit of some sort? And the thing that is going to make people prefer the bank credit is interest. So when the interest rate reaches a proper rate, the market responds by dishoarding their gold. That is why England, in particular, outcompeted and became more and more successful relative to the other European powers. Is that English law allowed for not only the formation of banks, but allowed and encouraged people to trust those banks because there was the rule of law. And if the bank couldn't honor its obligation to return your gold, the bank was bankrupt and you'd get your gold back and it came out of the equity of the owners of the bank. And so that's what enabled people to trust the banks. That's what allowed the banks to aggregate capital, to invest in industrializing and railroads and all those things. Um, and so what monetary metals is trying to do is to bring about that kind of monetary revolution, not to petition the government and say, would you please pass a law to create a gold standard, which will never work for 100 reasons, not least of which is that even the conservatives are really not interested in the gold standard right now. Um, but not petition the government, but by doing what Uber did and just providing a better solution, um, and then just offering that to people.
Okay. Okay.
and Uber proved that that can work.
Okay. Thank you for that explanation. Okay, Keith, just in summary, can you again tell the audience what is the name of your theory and how they can get in touch with you or read more about your work?
So I just, in all humility, I just call my theory of interest and prices. I think it was in paper currency, and that's on our website. That's also syndicated. There's a number of sites around the world that would have that. It's 6 parts plus one supplement, so it's a total of 7 parts. And we have a landing page. So if you want, I can give you the URL to that, and you can publish that for your subscribers. We have a landing page with all 7 of the articles in that series. And our website is monetary